Welcome to the TreppWire Podcast, the show where commercial real estate meets data and insights. This is our week in review for the week ending June 19th, 2026. I'm Haley Keene with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Lonnie Hendry, Chief Product Officer, and Stephen Bushbaum, Head of Applied Research and Analytics. This week, the macro story really starts with the Fed. The FOMC held rates steady at 3.5% to 3.75%, but this was not a quiet meeting. It was Kevin Warsh's first meeting as Fed chair. The statement was notably direct, and the updated projections suggested the committee is still wrestling with inflation that has not fully cooperated. At the same time, the economic data gave both sides of the argument something to point to. Retail sales came in stronger than expected, up to 0.9% in May, which suggests the consumer still has some spending power. But housing starts dropped sharply, builder sentiment remains weak, and import prices rose again, largely because of fuel. So the Fed is looking at an economy that is still expanding, but with inflation pressure and rate-sensitive sectors still under strain. For commercial real estate, that matters because the higher for longer conversation has not gone away. Treasury yields, refinancing math, debt availability, and cap rate expectations are all tied to whether the market sees cuts, pauses, or even another rate hike later this year. We also had a notable CRE capital markets headline. Apollo Commercial Real Estate Finance announced plans to dissolve and liquidate assets after selling its loan portfolio earlier this year. This is not the whole CRE story, but it is another reminder that the cleanup phase is still working its way through the market. We'll also share some sentiment from a recent discussion we had with Scott Rechler of RXR and walk through a 101 on credit risk transfer, along with sharing some of Trepp's latest trading alerts. So Stephen, starting with the Fed, what stood out to you from Warsh's first meeting, and how should CRE investors be reading this week's data?
The biggest takeaway from this meeting is that it's not just a new Fed chair. It may be a pretty meaningful change in how the Fed communicates and manages markets. Kevin Warsh has been very clear that he is not a big believer in forward guidance. So instead of the market getting a carefully messaged roadmap for the next several meetings, we may get a much more concise Fed. Here's what we see, here's what we are doing, and markets can price the path from there. And that may be refreshing, but it also may lead to more uncertainty for investors who had gotten used to leaning on the Fed's language for rate cut timing. And the press conference was actually pretty funny today because a lot of journalists kept bringing up the forward guidance again and again and again. And Kevin Warsh kept shooting it down again and again and again, saying, I have nothing further to add. So, basically what we saw today was that the 2-year Treasury yield spiked 13%. The 10-year yield moved up about like 2 to 3 basis points. And that basically led to a bear flattener. The curve flattened by about 10 basis points. So this is a really interesting market reaction. On the long end, bond investors were clearly saying, finally, we're going to tackle inflation. We have a little bit more confidence. We don't need to price in as much of a risk premium. But on the short end, obviously that rate hike possibility is getting calibrated into the short end. Now, the other big shift is around balance sheet policy. Warsh has been critical about QE, so the market should probably not assume that the Fed is going to step in quickly to calm bond market volatility or rescue duration risk. For CRE, that matters because cap rates, refinancing costs, and credit spreads are all tied to what the bond market believes the Fed will tolerate. And so all of this is to tackle inflation that's been very stubborn over the last 5 years. Warsh was, very upfront about that and very critical of it. He said it many times throughout the meeting that basically inflation has been above their target and this is not acceptable. We're going to fix this problem. Now, how exactly it gets fixed is a big question mark because there's a lot of different things changing all at once, from how we measure inflation to how we're managing current rates. And we're not going to be managing forward expectations, but to some extent, it's going to be a much more straightforward reaction function. The Fed says what has happened, and the markets are going to basically imply from there. So we're going to have a lot less of this circular reference going on with the Fed trying to guide markets, and then the markets trying to, play back into Fed management of money, rates, and tightness. So it's a really interesting situation here. Lonnie, how did you feel about this meeting? Was this refreshing? Do you see some caution? Do you see some upside? Like what? This is a really interesting pivot because the script has basically been ripped up from the last 20 years.
Yeah, and I I'm actually intrigued, I think would be the way I frame this, in the sense that, with him stepping in and this being the first meeting, you want someone that's taking over to have like a game plan or a go forward strategy. And I think he clearly articulated like the old ways of doing business are not going to be tolerated under his watch. So from that perspective, I'm intrigued. I'm maybe a little skeptical relative to like how much change he can actually affect, just because the government moves slow. 20 years worth of kind of standard process is hard to change. You have an administration that very clearly has an agenda. So there's a lot of there's a lot of just, logical, bureaucratic process red tape that you're going to have to jump through. So I think for me, I'm excited to see that he kind of stood up at the podium and said, here's what I believe. I think the way we've been measuring some of these inflationary things is maybe not up to snuff. I think the inflation as it stood the last couple of years is higher than what we can tolerate. One thing that I think maybe doesn't get as much publicity after the meeting because of the focus on the dot plot and the forward guidance, which quite honestly, forward guidance, who knows? Who knows? Like, I don't really disagree with his perspective of like the forecasting component. I think it provides a false sense of hope or security or fear, depending on what the readings are, without really any real data on the forward end of that. But the one thing that I wanted to highlight was that he was forming a task force to look at what they call overhauling major Fed operations. So kind of ambiguous, kind of all-encompassing, kind of goes against the narrative maybe that there's going to be like some quick changes, because anytime you have a task force reviewing things, it usually slows the process down. But I think that's an interesting kind of tidbit that we'll be keeping an eye on as things progress, is, maybe he is serious about overhauling substantial components of the process, and he's just waiting on getting, some consensus. The other thing that was interesting was that this was a unanimous vote to keep the benchmark rate where it's been, which I think is an interesting tidbit given the last couple of months. You haven't had that type of unanimous support.
Yeah, that was interesting. We no longer saw that one call for rate cuts included in there. And I'm wondering how much of that was getting kind of whipped in line and how much of that is basically saying, all right, the fight for Fed share is over, so I'm just going to fall in line with consensus. Or maybe it's conceding to the data, right? We've had too much inflation right now, and the economy is still performing too strong to say that there's any rationale for cutting rates. So I think it's maybe a little bit of a mixture of all those, but yeah, the data certainly is not screaming cut anytime soon.
Well, if you look at 18 of 19 possible responses, median estimate for the Fed funds rate at the end of 26 is now 3.8%, up from 3.4% in the prior projections from March. So I think, if you were going to take away something here as forward guidance, we would estimate that there's probably at least one rate hike somewhere through the rest of this year. I think the path for cutting has been closed off. You're going to see, holds or potentially even a rate hike. And, I wonder at what point, Stephen, can we get away from saying the higher for longer? Like it's not higher for longer. This is just the new reality.
Yeah. Can we just start calling it neutral? Because it's kind of what it feels like.
Agreed.
Maybe this is neutral. Maybe we actually reached it. Now, that's all going to change probably a little bit if we can get more accurate readings on inflation in the economy. Warsh was really critical about that during his press conference, basically saying like, look, this is antiquated. We have low survey responses. The stuff that we're measuring might have captured the economy for like your parents' generation, but not for ours. So we're going to fix this stuff. It's overdue.
Well, I think if you've been listening to this podcast for any length of time, you and I have had very similar conversations over the last 18 to 24 months. Like, it's by definition an antiquated process that doesn't account for the modern economy, and it doesn't account for any of the modern data that's available that they could and should be using to actually give a real-time read of where inflation actually is. It's accepted. It's broadly approved of in terms of people trusting it. But I'm with him. Like, this stuff needs to be revamped because there's much more real-time, insightful, impactful, informative information available that just today is not part of the process.
So let's turn here to some of the major CRE stories we saw this week. I mentioned it earlier, but there were headlines that Apollo is winding down its Apollo Commercial Real Estate Finance business, the publicly traded commercial mortgage REIT, after selling most of the platform's assets to Athene. So walk us through this story and if it's a broader sign for the market.
Yes. So this news, I think, came out earlier this year, maybe 2 or 3 months ago, just announcing the sale. And so this is the actual closing of the transaction. So Apollo is winding down Apollo Commercial Real Estate Finance. It's publicly traded commercial mortgage REIT. And as you mentioned, Haley, they're selling the platform's assets to Athene. ARI had already agreed in January to sell roughly $9 billion of loan commitments to Athene, the insurance company Apollo acquired in 2022, and the board has now decided to liquidate the remaining assets and distribute proceeds to shareholders. The transaction is notable because Athene paid 99.7% of par value for the loan portfolio, which represented a roughly 23% premium to ARI's share price at the time. That is important context because public REIT valuations have continued to lag private market valuations, creating pressure for some publicly traded real estate vehicles to consider sales, mergers, or liquidation. So you might have remembered just a couple episodes ago, we went through the multifamily REIT merger and some of the math there. And a big part of the rationale was just how big of the discount there was for book value or net asset value to share price. So we're seeing basically something similar here. The loan book was diversified, but still exposed to several property types facing higher scrutiny. As of the first quarter, residential made up 29% of the portfolio, office was 23%, hotels were 19%, industrial was 11%. And the weighted average fully extended remaining loan term was about 3 years. After the sale, ARI is left with roughly $1.4 billion in cash and a smaller group of equity interests. So this is a really interesting transaction. I'm sure it's going to get a lot of mentions on LinkedIn, particularly from our friend, Rod Dubitsky, because he has been all over the Apollo Athene transactions. And so I'm sure he's going to have some interesting LinkedIn posts for us on this particular transaction.
Yeah, so I think that transaction was announced back in April, Stephen. So just to give people a timeline, April to now middle of June. And, in addition, I don't know if you saw this headline this week, but Apollo Global has announced that they're going to have a second headquarters in Austin. And so you're going to see a much bigger footprint in the Lone Star State. They're $1 trillion private capital giant. It was between Austin and another city in Florida. And if you want to know why, maybe they picked Austin, I think that comes down to kind of 3 main points. Tax advantages. Clearly, Texas has a significant cost savings benefit for them. If you look at personal and corporate tax burdens that they have in their traditional Manhattan base, Austin and Texas broadly, no state income tax, very business friendly on the corporate side. Tech and AI integration is plug and play here in Austin, where you have private equity, firms going to be right in the middle of the AI infrastructure, fintech hubs, software development talent. I mean, outside of San Francisco, Austin's considered a really great stronghold for tech talent at a significant discount to San Fran. And then, just the industry shift. I think we've talked about this with Y'all Street and some of these other draws that are bringing people to Texas. I said draw, not drawl, although we have both here in Texas. But the draws are very strong in the sense that landscape is changing and people's perspective of Texas is now one of a financial services, hotspot. And you're going to see more, I think, of these types of co-location or dual headquarter type of locations. So it'll be very interesting to see how, this plays out and if this spurs kind of a flurry of others to maybe choose Texas as a second location.
It certainly has the momentum going for it. I mean, I honestly wouldn't be surprised to see, another half dozen of these major announcements because heaven knows Texas has the space and it certainly has the business-friendly climate going for it. That lack of personal sales, that lack of personal income tax certainly is a nice pay increase. So end up paying for it through property tax a little bit.
Yeah, I was going to say the big winners here might be the multifamily owner operators that have been struggling with high vacancy. You get some of these large corporate relocations, brings high paying jobs, is going to give some pricing power back to those multifamily owners. I think it's going to be exciting. And if you look at just the office space play here, right now Austin's Class A vacancy sits at about 25%. So you're going to have a pretty good time picking great locations if you're Apollo for your office spot. So I think a couple of buildings that are in contention, according to some internet chatter, is 6 in Guadalupe, 415 Colorado, and the Springdale Green Campus. You'll see a lot of landlords rolling out the red carpet to try to lure them into their building because I think it'll be a great get.
So we wanted to do a quick plug here. In case you missed it, we released a special episode of the TreppWire podcast with Scott Rechler, the chairman and CEO of RXR. And this was a live recorded episode of our keynote conversation that took place at our Trepp Connect in New York City conference. But what we really didn't get to do was give our comments and hear from you guys on what you thought about some of the themes and topics that he spoke about. He had some really great quotes in his discussion, and the major theme that he introduced to our audience was that as we enter 2026, we may have crossed that chasm, but on the other side, we entered the age of disruption. So walk us through what he means by this age of disruption, and then maybe you can walk us through some of the other quotes and themes that he introduced and that we might have some data or commentary on.
This is a guy that runs an incredibly successful business, branched out beyond New York City to many other states at this point. And it was really remarkable just to see how well connected he was to his business. I mean, he was giving very granular insight and details on particular projects and deals that his team's running. And so like for me, as someone that, we all live in the data and we read the stories and we navigate what's happening in the market day to day, week to week, it was really remarkable just to see someone of his stature, one, be so approachable, down to earth, and just a great get for us. And then he lived up to expectations when he joined the stage, but then also just how firmly his grasp is on the company and kind of where it's headed and what it's doing. But, to the point of the disruption, I mean, I think the major takeaway was that he views disruption in a positive manner. That disruption really creates opportunities. And I think one of the things that I took from his commentary was that he said he's most comfortable when you got to work hard, you got to be operators, you got to focus on building your business. And I think that's why he's successful. Like that's the mindset. Those are the skills. That's the kind of prerequisite for anyone that's going to be doing development or repositioning or anything else. It's not an easy job, and it's the signs of opportunity are not there, in a really nice, easy to digest manner. Like you got to find opportunities whenever and wherever you can. And he's figured out a way to look at distress and turn it into a positive, and his company's done a great job with that. So I don't know what your thoughts were around the distress narrative, Stephen, but I think for him, and listen, some of this is forced in the sense that he's got some properties in the portfolio that are, dealing with some distress. But even in that scenario, he's figuring out a way to strategically divest from those and move into some more, fruitful opportunities.
No, I think you hit it square in the head there. And some of his, one-liners really sum up those main takeaways, right? That disruption breeds opportunity. And you have to get comfortable with being uncomfortable if you want to do well in this industry and through cycles. So like just one specific disruption element was, right, that he was viewing AI as an augmentation and not as a displacement, right? It's a force multiplier. It can enable us to do a lot of cool things that maybe weren't possible before or took a lot longer to do. So it's interesting to hear, some of the specifics around how he specifically and his team is using AI, just in their daily workflows. And to the other side of the, you should get comfortable being uncomfortable and disruption breeds opportunity. And one of the corners of the market that he pointed to was data centers, right? It certainly looks like that corner of the market might be getting a bit frothy. And I mean, shoot, Lonnie, we've talked about that a little bit, that so much money is chasing this asset class that it's kind of hard not to stop and ask yourself, are some of these assets being overvalued or being accurately valued?
Well, I've seen some stuff online where people were reminding appraisers and others that data centers are not valued on a per square foot basis. They're valued on their ability to produce in a wattage framework, not a per square foot framework. So that by itself, to me, makes this borderline maybe not real estate. But I think to some of your other insights, Stephen, let me go back to, we know that the majority of his portfolio is office, and it's in the New York region, right? And so I wanted to just throw a little bit of data at you here and get your thoughts on this. So if we look at office originations in New York across the state, so I'm looking across the state, but obviously this is concentrated in the city. And I want to give you some weighted average cap rate data, and you give me a reaction to this. This is what he's competing with now as he's referenced some of his Polaroid office buildings in an iPhone world. Q1 of 2024, NYC office cap rates, 5.57. This is weighted average cap rate on new origination. 2024, Q2, 4.44%. Q3 2024, 6.27%. Q4 of 2024, we peak out at 7.75%. Now let's fast forward to 2025. I'll give you the 4 quarters of 2025. Q1, 4.96%, Q2, 6.43%, Q3, 4.7%, Q4, 6.54%. Any thoughts or any general takeaways? That seems like, one, we know these are high-end, Class A, highly amenitized, but any thoughts on those cap rates being as low as they are for office origination?
Yeah, the 6 handle, I can wrap my head around. The 4 handle, I start having a lot of question marks roll through my mind. But like 6.5, okay, sure. It's New York City office. I could get on board with that. I mean, I know a lot of offices traded hands at like 8.5%, 9.5% in some of these secondary markets. And so that New York City premium is getting baked in. But when we go sub 6, or heaven forbid, like you just said, sub 5, woo, where's the return? Where's the juice coming from?
It's really interesting. So let's just take a national perspective. If you look at trailing 12-month weighted average cap rate, this is at NOI for office nationally. What do you think that number is, Stephen, before I give it to you?
I would hope probably it's weighted average.
Weighted average trailing 12-month NOI cap rate.
I mean, I would suspect 6.5 to 7.5.
5.49%.
Yeah, there you go. It's because New York is pulling everything else down.
It's bringing everything down. So if you just want to do like a quick evaluation of the last couple of years, 2024 was the high water mark, 6.74% nationally. Now, again, there's some bias selection here in the sense that these are properties that were able to get financing, right? Whether it be acquisition or refinance. But these are, cream of the crop kind of trophy assets. So like by definition, this is going to be the very bottom end of the cap rate spectrum. But 2022 nationally, 5.32%. 2023, 5.93%. 2024, 6.74%. 2025, 5.51%.
Yeah, that's the selection bias effect right there for you. The only stuff that, really the bond market really wants to digest is the best of the best of the best.
One other thing, and this kind of ties into where we started the podcast today with the FOMC meeting, Stephen, was that he said that, the house view for his firm is that rates are going to be higher for longer. And he actually said he thinks that the 2% target is aggressive, and he thinks the Fed really should set inflation expectations around 3% in today's marketplace.
Yeah, I think that is appropriate. I personally would even prefer a range bounds model, saying 2.25, 2.75, or 2.5 to 3. I think 3%, I get it. We could probably run at 3% and not run it too hot. But again, that's where I would prefer maybe to run a range bound 2.5 to 3 rather than just saying, flat 3.
Yeah, I agree with that too. I mean, as I get older in life, I'm getting much more comfortable with range bound pretty much in everything, because I do think there's a spectrum of outcomes that are acceptable across the landscape. And I'm with you. I think a range bound 2.5 to 3. But at the same time, if you look at the broader economy, and we've talked about this for a while, I mean, despite the headwinds, despite all of the negativity, despite all of the predicted recessions, despite everything that we thought might happen, it's still going pretty strong. And I don't know if we're underestimating at some level the fact that we should tighten things up a little bit more, because it feels like broadly there's still quite a bit of juice left in the macro.
So especially on today's episode, we spent a lot of time talking about interest rates and what higher for longer means for commercial real estate. But another important piece of the lending equation is capital. How do banks create capacity to keep lending even when capital requirements remain elevated? That's why we want to focus on this 101 topic today, which is on credit risk transfer. So we're going to walk through CRT and what it means for CRE lending.
Yes. So this 101 is based on a blog that we have coming out here at Trepp that walks through some of the different types of credit risk transfer and basically some numerical examples and what it means or what it could mean for real estate lending. So at the simplest level, a CRT or credit risk transfer allows a bank to transfer a defined slice of credit risk on a loan portfolio to outside investors without selling the loans. The bank keeps the loans on its balance sheet, keeps the borrower relationships, keeps collecting interest income, and continues to monitor the collateral. But behind the scenes, it buys protection against losses on part of that loan pool. You may also hear this referred to as synthetic risk transfer, synthetic securitization, or a capital relief trade. The concept is basically the same. The bank keeps the asset, but transfers some of the loss risk. Now, there are a few ways to structure this, but the most important US structure is often the credit-linked note, or CLN. With a credit-linked note, or a CLN, investors buy a note tied to the performance of a reference pool of loans. They receive interest payments, but their principal is at risk if portfolio losses exceed certain thresholds. In a fully funded CLN, the investor proceeds are held as collateral, which helps reduce counterparty risk. And the reason this matters is capital efficiency. So just as a quick aside, you may have heard of like a credit default swap, or a CDS. And a credit default swap, or CDS, is where you're buying protection, but in that sort of a structure, you have counterparty risk. If losses exceed a threshold, what if your counterparty doesn't have the capital to pay up? When it's a credit-linked note where the principal is actually held in the bank's account, that counterparty risk is completely removed. So CRE loans can consume a lot of regulatory capital. A bank may hold a fundamentally strong CRE portfolio, but still face high risk-weighted assets under standardized capital rules. A CRT can reduce that capital burden if the bank transfers a mezzanine slice of the credit risk to investors. So this Trepp blog uses a stylized example of a $500 million multifamily portfolio. Before the CRT, the portfolio carries $500 million of risk-weighted assets, requiring about $40 million of CET1 capital at an 8% requirement. After the CRT structure, the risk-weighted assets fall roughly to just $78 million, and the required CET capital drops to about $6 million. That frees up $34 million in capital. So it is a massive, massive benefit to the bank. And that's the core value proposition. The bank still has the same loans and the same borrowers, but less regulatory capital tied up in that exposure. And that can improve return on capital and create more room for new lending and help banks manage CRE concentration pressure. So what's going to be interesting here is with future changes or proposed changes to the Basel III, what used to be called the Basel III endgame, that's getting reworked. So the long and short of it is these credit risk transfers used to require approval on a transaction by transaction basis. But under the new proposals, if it is a credit-linked note where the principal is actually deposited with the bank and it removes that counterparty risk, well, it wouldn't require that same regulatory approval. It just shifts the burden to ongoing regulatory oversight. So in other words, regulators have to do their job on the regular semi-annual, annual, quarterly, whatever the cadence is, on their monitoring of the bank and, well, the risk assessment. So this is a really interesting proposal that could, I think, reshape the bank lending landscape in a very meaningful way. But it's very early times. Again, this is a proposal. It's out for comment. So we still have a long way to go before this becomes a reality.
I think it's important to point out, Stephen, that it doesn't fix bad loans or weak performance at the property level, right? So, I mean, if you have bad credit, you got this impending maturity wall wave, whatever you want to call it, and the mathematical refinancing problems that come with the low interest rate deals having to refinance. I mean, with anything in life, it's kind of, moderation, diversification. Those are things that usually yield good results. And so I think in this instance, diversified pools of stronger, more predictable loans, stabilized income producing properties, good cash flow, all those things are important here, which obviously those are what everyone strives for to begin with. But, it doesn't eliminate the risk of poor underwriting, poor performance, or some of these loans that maybe aren't able to generate cash flow.
That's right. And the blog that we're releasing walks through some of the strong candidates and the weak candidates for this type of structure. So rarely, if ever in life, is there, a silver bullet to fix all problems. Typically, there are good solutions that can have broad applicability and weak solutions that have very narrow applicability. So a little bit early to say exactly how much capital this proposal could free up, but knowing that there's a lot of banks out there that do some low leverage, stable, small balance lending, those will be very strong candidate banks for this type of structure to free up potentially a decent amount of risk capital.
So one more plug here. We got a lot of interest last week in our issuance analysis where we looked at refi versus acquisition activity. And I know, Stephen, you've done even further digging into that You've actually extended last week's analysis and have drilled down into the MSAs. So we're teasing that out here. We will have last week's information plus this new extension on our upcoming Market Pulse webinar that's taking place Tuesday, June 30th at 2 p.m. Eastern. So reach out to us if you were interested in last week's analysis or want to learn more or would like to see even further deep dives from our team. We'd be happy to talk to you about that. Now, I'll turn us to our deals and data segment. We have a lot of property type stories to cover this week. We had a lot of new remittance data come in from Trepp, so we released several trading alerts for our clients. We'll walk through some of those this week and also just other deals or headlines in the commercial real estate market that caught our eye. I'll start here in office. There was a headline from our friends over at Connect CRE that downtown LA's Bank of America Plaza has traded for $210 million in receivership.
This is a particularly juicy story because Bank of America Plaza backs a couple different loan pieces across 4 different 2014 CMBS conduit deals. And this trade implies that there's going to be a rather large loss flowing through these pools. So Bank of America Plaza in downtown LA traded for $210 million through a receivership sale, giving the market another major distressed office pricing data point. The 1.4 million square foot tower at 333 South Hope Street is reportedly the largest office sale in Los Angeles so far this year and the largest in Los Angeles County since 2023. The buyer is Capital Group, which makes this a very different story than a pure third-party investor stepping into downtown office risk. Capital Group has been a tenant in the building since 1978. They already occupy 14 floors and plan to add 5 more as it consolidates locally and moves its employees from 3 different locations into that building. That tenant-driven angle is probably the most important part of the story. The building will remain multi-tenant, but Capital Group is now both the owner and anchor tenant, giving it more control over a long-term workplace footprint in a building it already knows well. The B of A Plaza property backs $400 million in CMBS debt that's spread across 4 2014 conduit deals. So after selling expenses and servicer reimbursements and, well, all other selling costs, the loss on this liquidation is likely going to exceed 50%. And so this is a really large liquidation that's going to be felt across a few different 2014 CMBS deals that have yet to fully wind down.
Do you think we'll see more of this? I think this is a great play if you're a long-term tenant in a building where you can acquire something at a basis that's incredibly attractive and gives you significant control over the asset for your own operations, but still allows you to offset on the upside the cost of ownership when the market comes back and you're able to get strong office rents, office market rents in a city like LA. I mean, now listen, we didn't really get into it in the Rechler segment, but he was saying some of these legacy office markets might be like a 20-year reclamation project. I don't think LA is going to fit that bill. I think they'll get it figured out before then. But if I'm Capital Group, I'm feeling really good about this deal. You're buying a building that you are very familiar with in a market that allows you to consolidate your workforce, add efficiencies from that perspective, and continue to lease out the remainder of the building to other tenants. I think this is a home run for them.
For Capital Group, absolutely. But I would be more cautious on a more general play because as we've learned from this most recent office cycle, office can be a very, very capital intensive property type to own and operate. And so what I would caution some tenant owners about here is, right, if you already have the expertise, right, if this is already kind of in your wheelhouse, absolutely go for it if the basis makes sense. But if this is not in your wheelhouse and it's kind of a one-off play, make sure your pencil is sharp on CapEx and what it's actually going to take to maximize building value, because this could end up being a very, very costly endeavor if you are already cash strapped. This might not be a good play.
Yeah, fair points.
So let's talk about a different type of trade, and that's a trading alert about a large Manhattan office loan that has transferred to special servicing. This is the $290 million 26 Broadway loan that transferred to special servicing last month due to imminent monetary default, and the loan matures in February 2032.
Yes, special servicer commentary noted that the loan has been subject to cash management since January 2026. The servicer is currently in talks with the borrower to determine a resolution strategy. The loan's collateral is an 840,000 square foot office property in Manhattan that was built in 1883. The property was 75% occupied and generated $12.2 million of net cash flow through the 12 months ending March 2026. However, it was underwritten to generate $19.3 million at the time of the loan securitization in 2022. The property's largest tenant, the New York City School, occupies a total of 35% of rentable space under two leases that expire in January 2039 and March 2041, respectively. Meanwhile, Seed Suite LLC and NYFA 26 Broadway LLC occupy nearly 6 and 5% of space in leases that run through year-end 27 and June 2030, respectively. The collateral was appraised at a value of $465 million at securitization. I should also mention this property supports an additional $40 million of mezzanine debt as well. The next trading alert we have is on Chicago's Illinois Center that was reappraised further below its loan balance. June remittance data revealed that the value of the collateral behind the $239.5 million Illinois Center loan was recently reappraised further below the loan's balance. We last mentioned this loan in a March 26 edition of TreppWire when the asset's value was reduced to $85.7 million from the $390 million value pegged to it at securitization in 2015. This month, the value was reduced to $66.5 million. The loan's collateral is a 2.1 million square foot office property at 111 East Wacker Drive and 233 North Michigan Avenue in Chicago. Its two buildings were constructed in 1869 and 1972 respectively and were renovated in 2014. A report in Commercial Real Estate Direct noted that the loan's collateral is only 33% occupied and generated a loss as of the first quarter of this year. Special servicer L&R Partners initiated foreclosure proceedings in July 25, and in February 2026, TriGuild IVL was appointed as the property's receiver. Top tenants at the 111 East Wacker building are Taft Statinis, the Illinois Housing Development Authority, and Traffic Tech, which occupy 10.5, 6.5, and 5.4% of rentable space under leases that run through August 2034, this coming October, and May 2034, respectively. Meanwhile, iHeartMedia Entertainment is the largest tenant at 233 North Michigan, leasing 3% through July 2034.
Stephen, on this deal here, $66.5 million and 2.1 million square feet gets you a value of about $31 a square foot.
Ooh, you a buy there?
I don't know that I'm a buyer here. I mean, these are crazy old properties. The tenant roster is not super strong. And when the Illinois Housing Development Authority is your largest, second largest tenant in one of the buildings, they have a lease expiring this upcoming October. Not feeling super great about it. I mean, listen, I want Chicago's office market to come back. I'm a huge supporter of the city. We've seen a nice rebound in the multifamily sector there. I think this is one that even at $33 a square foot, probably has to see a little bit more in terms of reduction before you start seeing a wide appeal across the landscape. Now, I mean, just put that in perspective. I mean, securitization value in 2015 of $390 million down to 66.5, and we're debating on whether we think it's low enough for people to actually take some action here. Just that quantifies for people just the type of value loss that some of these markets and individual buildings have realized.
So turning to multifamily, we saw a headline this week that Affinius Capital has lent $120 million against a San Diego apartment property.
So Affinius has been busy. I know we've had multiple stories from them over the last several quarters, and this is no slowing down, it feels like. They provided a $120 million loan, as you mentioned, Haley. This is for financing of the 302-unit LON apartments in San Diego. Takes out the property's previous construction financing, which had $65.4 million outstanding loan from Bank OZK and a $34 million preferred equity line from Pacific Urban. So this consolidates that into one permanent loan. Bank OZK's loan was set to mature in March of 2027. The property was developed and is owned by AAA Management out of San Diego. It opened up earlier this year. It's got a combination of studio, 1, 2, and 3 bedroom units that range in size from 469 square feet to 1,597. JLL arranged the new debt. And Stephen, I got to tell you, I like seeing these types of stories because as you and I have highlighted over the last couple of months on our Market Pulse webinars, these lease-up new construction properties across the U.S. have been struggling to kind of hit their benchmarks. So takeout financing's not been readily available. A lot of these have had to go from construction to bridge or other short-term notes. It's great to see that we finally got a story here that kind of puts a little bit of a pause button on that and gives us some positive transactions to talk about.
Yeah, exactly. The amount of bridge to bridge that we've been seeing, and I'm sure we're going to be continuing to talk about for the next couple of months. It's been a little bit disheartening. So this is definitely a green shoot. Nice to see.
And San Diego is a great location. I mean, they were hit pretty hard with some of the office stuff, as most other large cities were. I think San Diego, for other reasons, weather, quality of life, it's a market that people are drawn to, and so it's good to see that they've got a nice positive story here. And I've got a couple of others. We'll kind of run through these pretty quickly, but our next one comes to us in industrial. This is out of Davie, Florida. So we're getting outside the beaten path here. Prologis, that's a pretty well-known name. Might have heard of them. Paid $352.16 million, or over $306 a square foot for Davie Business Center, which is a 1.15 million square foot industrial complex. Prologis, as I mentioned, everyone knows, San Francisco Industrial REIT, purchased it from the developer, which in this case was IDI Logistics out of Atlanta. It's a 7-building property built between 2013 and 2022, 9 miles west of Fort Lauderdale Hollywood International Airport. And get this, Stephen, you won't be surprised here. Across 25 tenants in the 7 buildings, property is currently 97% leased and has clear heights between 30 and 32%. So no shortage of demand, and the price reflects it.
So how long before it gets to 100%?
I don't think it'll get to 100%, right? I mean, aren't we taught that if you get above 94, 95%, it means you got to start pushing rents. And so you want to have a little bit of that frictional vacancy. I think 97, for all intents and purposes, is really 100. And so let's transition here. We got 2 more sectors that we'll get to: lodging and retail. We'll start with retail. This is a trading alert. So for our TreppWire recipients, current clients, you would have received this via email, but large retail portfolio loan returns to special servicing. This is the IMC portfolio, $975 million loan transferred back to special servicing due to imminent balloon maturity default. We mentioned this property back in April of 24 when it was transferred to special servicing ahead of its maturity because nobody expected it to pay off. It was modified, borrower paid down about $175 million, and the term was extended 2 years to this month. Well, guess what? They still aren't able to pay off, and so it was returned to the special servicer. So after effectively being cured by the modification, it's a 16 property retail portfolio. It totals 9.6 million square feet in Las Vegas and High Point, North Carolina. Properties were constructed between 1907 and 2017. 11 of the 16 properties were renovated in some form between 1991 and 2014. And if you look at the portfolio in total over the last 12 months, ending in March of 26, DSCR at net cash flow was 1.46x with 77% occupancy. So we've been pretty fortunate, Stephen, that a lot of our retail stories have been incredibly positive over the last year or so. This is one I think still has some ability to cure, but it definitely has probably another capital contribution from the borrower required to make that happen.
Yeah, you and I have talked about this a couple of times over the last year or so, that what was going to happen when these modified loans came around to their extended modification date. Would they be able to refinance and pay off, or was this going to be basically Groundhog Day? And for some of these loans, it's starting to look a little bit like Groundhog Day.
Yeah, I mean, it's interesting because generally, if the borrower pays down $175 million, they feel pretty strongly that they're going to be able to turn it around. The fact that it hasn't turned around, I think, is indicative of maybe some broader challenges. But I would be shocked at this point. The debt service is still above 1.25. Occupancy, isn't great, but it's not like some of those Chicago offices we talked about. So hopefully they can figure something out here. But to your point, how many more extensions or modifications can you give something when you're already 2 years post original maturity and there's not been significant correction to the performance of the property?
Yeah, and for a loan of this size, it's not like there's a bunch of different options out there to refinance into, right? We're not going to bounce from a bank to a life company to maybe conduit financing or whatever. I mean, it's really SASB or maybe a syndicated financing, but there's probably, only a handful of viable refi option outlets out there for a portfolio like this.
Maybe you can take us home, Stephen, with this last lodging trading alert.
Yes, we have an Austin hotel SASB loan that has been sent to special servicing. The $430 million Fairmont Austin loan was transferred to special servicing due to non-monetary default, according to June remit data. The loan matures in July 2029 and is current with its payments. However, special servicer commentary noted that the borrower, Manchester Financial Group, tapped a reserve fund to pay some of the property's taxes without consent from its lender. That resulted in the loan's transfer to Midland Loan Services. The loan collateral is a 1,048-room full-service lodging property in Austin, Texas that was built in 2018. During the 12 months through March 2026, the property generated $26.23 million of net cash flow and operated at 54% occupancy, leaving it roughly 22% below the amount needed to fully service the mortgage. The property was appraised at $615 million at the time of the securitization in 2024.
This property is an interesting one, Stephen. You said it was built in 2018, but if I'm going to pull it up here, but my recollection is I think it opened right around COVID. I mean, it maybe had a little bit of a runway right before COVID, but this has been a property that, was touted as incredibly nice, right in the heart of downtown Austin, great visibility off the highway, incredible, build out, et cetera, et cetera. And it's just run into a string of some bad luck here. And so, hopefully there's been a lot of construction there. In fact, I don't know if you saw, there was an old Radisson that actually sits on the river there, that, right next to the Four Seasons that was purchased maybe around 2018-ish, maybe 2019, that was rebranded as The Line. Shout out Carly Cinto, who stayed there a couple of times at one of our conferences, but it just went into foreclosure. There's been a couple of these assets that have just really struggled. That market has not been able to produce the sustainable occupancy that's needed to support some of these higher end hotels.
So as always, those are not our only stories from the week. We had several other trading alerts that we sent out to clients, more deals, acquisitions, and stories in our daily The Rundown newsletter. And of course, we had webinars and other things that you could check out. So that will lead me into our programming notes of the week. If you're listening to this, you're a little bit late to our banking webinar, but I wanted to give a plug for that quickly because quarterly we'll host a lending market snapshot webinar where we share key trends in bank, CRE, C&I, and NBFI portfolios. And we use insights from our TALR, which is our Trepp Anonymized Loan Level Repository Report, which anonymizes loan level data from large and mid-sized financial institutions. And we walk through what today's portfolio activity reveals about the broader lending environment. So you missed that webinar, but we'd be happy to walk you through our taller data and any of the signs we're seeing in the lending market. So reach out to us at podcast@trepp.com. If this is your area of interest and you'd like more information on the bank data set that we manage or any of the insights that we've shared on that webinar. Of course, we mentioned the Scott Rechler episode, so if you haven't checked out episode 401 of our podcast yet, please go do that. I also just wanted to say another thank you to everyone for all the excitement around our 400th episode. The team was joking this week that we have so much lined up when it comes to weekly episodes or guest episodes that we might be having a huge 500 episode celebration sooner than we've even realized. So with that, I'll ask you all, if you're listening to this, please go rate our show on Spotify, leave us a review on Apple Podcasts, or send the show to a friend. It's been so cool to hear how many of you found the show because of an old colleague or someone you met at a conference, and we really appreciate all the support. We do have one webinar that we mentioned earlier, our Market Pulse webinar, and you still have time to sign up for that. That's taking place again on Tuesday, June 30th at 2 p.m. Eastern. We will walk through that issuance data and do an even deeper dive into the analysis. We'll also look at value add multifamily and really dig into 1970s vintage assets in CRE CLOs. We'll look at how value add business plans have performed and what recent valuation trends say about the risk profile of these loans. and we'll do a self-storage deep dive. So I know a lot of times on this podcast, we cover the major asset classes, but we also have data on other property types such as self-storage. So we'll walk through performance, fundamentals, and what some CMBS data reveals about risk in the space. And one more webinar we have taking place before that. This is a client-only targeted training that we're hosting for our Trepp CRE clients on Thursday, June 25th at 2 p.m. Eastern. But this is one that if you reach out to us, we might be able to get you access to this recording or get you on the phone with someone from our team who can walk you through it. We are going to be demonstrating how to leverage Trepp AI and integrate MCP servers to bring the Trepp data and insights that you've trusted for so many years directly into your organization's AI workflows. So if you're someone who's been a listener for years, loved our data and our research, but you've never seen yourself logging into our front end platform, this might be something you're interested in because we can now get you our data directly into your LLMs and your systems that your organization is already building. So there's so many different ways that you can access our data now beyond APIs, data feeds, but now in MCP servers, and we have a lot more that we're rolling out. So reach out to us at podcast@trepp.com if you just want to walk through how we can get you access to our data and make sure it's accessible in your tools. And turning to shout outs, Jess B is a longtime listener and said she loves the insight we provide into what's happening in the market. A colleague heard from Mike S, who is a loyal listener who we need to reach back out to, and he said he's listened to at least some of all 400 episodes we've released. So thank you so much, Mike. Last week, we shared all of our future commercial real estate leaders. So go check out our LinkedIn post that highlights all of these emerging leaders in the industry. And on a future episode, I'll give a shout out to all those names. But we heard specifically from France B, who said he loves listening to us on the TreppWire podcast. We make the podcast fun, insightful, and he especially loved the 400th episode. And he's excited to follow along with Trepp's journey and continue growing in the industry. So it was so great to hear from you, France. AJJ was interested in the Market Pulse webinar on June 30th and said he loves the podcast. Susie S told us that Scott's episode was one of the most interesting real estate conversations she's heard. It's definitely worth a listen. Susie S also sent us a shout out from her client Ray T, who is a podcast listener and met with us at the CREFC conference. Joseph I said, great listen this morning as usual. He said he sent the episode to a friend and was interested in the issuance data that we shared. So Joseph, we will get back to you with those insights and send you a link to join us on our webinar where you can hear even more. Jason P said he enjoyed episode 400 and was interested in the issuance data and that it was a very fascinating way to look at the valuation bubble and the recovery based on the segmentation of the transaction activity. So we will get you that information as well, Jason.
I think we can't end the podcast, Haley, without at least talking about the Knicks winning the championship. Crazy parade incoming. So we'll see how that plays out. Hopefully everyone keeps their cool. And also the World Cup kicked off this week, which has been pretty impressive to watch. So I don't know if you guys, I'm not really a soccer or football fan, non-U.S. football fan, but I'm getting into the World Cup, man. Last night, Messi had 3 goals, which that's like some teams don't score 3 goals in like 5 games. So it's pretty incredible. So, and they're hosting games here in Dallas. So I love seeing the free market economy play itself out. All the fast food restaurants around the stadium are charging $100 per parking spot and won't even let you go into the restaurant and eat. Everything's gone drive-through only because they want to capture that parking revenue. So we won't be seeing that on their income and expense statements, I'm sure, but they're making a pretty nice profit just parking some cars for the games.
Well, and that third goal from Messi last night tied the all-time record. And I got to say, like, there's a little bit more to that story. I don't know if you caught this, but Messi's father, who is he's incredibly close with, he's basically his like de facto manager, business partner, but his father's health has been really, really poor. And he's been struggling since the beginning of the year. And just this past week, his father's health kind of took a negative turn. And so Messi's been playing with just an incredible amount of emotion, being carried with him. So to play like that last night, when you saw it on his face, like it was really emotional. It was incredible.
Yeah, it's, I'm not, like I said, I'm not really a soccer fan. So like watching these guys play, I'm just it's remarkable the kind of shape they're in. But as I was watching Messi last night, like he just kind of stands around when he doesn't have the ball, and I'm thinking to myself, like, he's just standing there, like he's not really doing anything. And then the guy, like, as soon as he gets the ball, he turns into a magician. It's incredible. So yeah, more to come on this. Shout out to our friend Michael H at Trepp that's made the trip down from Jersey to Texas, and he's taking in a game, England and Croatia. So getting to experience the Jerry Jones AT&T Stadium, although FIFA requires that it be referred to as the Dallas Stadium, even though it's located in Arlington, which is another thing. But yeah, more to come on this. USA dominated. Super pumped about that. So let's go.
Absolutely the best performance by the men's team for the USA I have ever seen. I mean, that was at least the first half, best football they have ever played. They legitimately looked like their European competitors for the first time ever. So really pumped about this one. I hope they can keep it up.
Lots of excitement right now. So with that, we'll close. Thanks to our producers, Carly Cento and Mariana Sabrana. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire podcast with your favorite provider. Thank you for listening and stay woke. All right.